In his show Mad Money, Jim Cramer said he expects a market pivot. He expects value stocks to regain traction and growth stocks to lose bad. He is wrong though, and here at the Money Network we will prove it. Jim Cramer explains that when the Federal Reserve, the Fed, decides to combat inflationary spiral with higher interest rates, you are not supposed to buy expensive growth stocks. The hedge fund playbook says that you should always sell stocks like Amazon and Apple and Facebook until the tightening cycle is nearly over. There is some reasoning in his statements, but he's definitely not touching the whole truth. In this video we will look at the theoretical background of interest rates, and then we will combine theory with practice and look how the theory withstood its test during historical interest rate hikes. In other words, how did the stock markets perform in previous rate hikes? And at the end of this video we will discuss what the upcoming rate hike in 2022 will set into motion and how it will affect your investment plan. But first of all, why do interest rates change? Well, it all depends on the current health of the economy. The Fed, the Federal Reserve in America, in the United States, keeps a close eye on its economy. If it runs smoothly, it doesn't need any help. And if there are problems, the Fed might decide to help the economy and give it more oxygen to keep on working. They do this by lowering the interest rates. Lower interest rates allow companies to get cheaper loans, meaning that they can lend more and invest more into their growth. Lower interest rates create more economic growth. Well, in most cases, low interest rates can remain low forever. That means that money remains cheap and lending money is essentially free. A lot of companies that should go bankrupt just don't. They remain in business making a loss and living off of loans. These companies are called zombie firms. To keep the economy healthy, zombie firms should go bankrupt. They have served their use, and by staying alive, they just keep other companies from growing. Anyway, the Fed will lower interest rates if they think the economy needs a boost. And this is the case when extremely bad events happen, like the start of a pandemic in 2020, or the economic downfall in 2008. When the Fed decides to lower the interest rates by printing more money, other central banks will soon answer and do the same, especially when the disaster is worldwide. Investors love lower interest rates. More loans means more money in the company they invest in, and that will boost their worth. So lower interest rates equals higher profits for company and for the investor. On the other hand, investors are getting nervous when interest rates are bound to rise. This will take air out of the markets, deflate the economy. The Fed and other central banks will raise interest rates when they see that the markets are picking up again, or when they are rising too fast. When they're rising too fast, they create bubbles in the economy. By raising the interest rates, they can limit the expansion of the market and keep the economy healthy. A central bank is essentially trying to keep the economy at a certain level. So they either lower interest rates when the economy is doing bad, and they are raising interest rates when the economy is doing well. But the investors are very wary when these interest hikes happen, because in the past they have often been followed by periods of recession. Now let's translate all this to a company valuation. When you buy a share of a company, you are partly owner of the company. That means that you are eligible for future cash flows that the company creates. You can compare it to buying a house and then earning rent from it in the future. Companies have a certain stock price, and that stock price multiplied by all the outstanding shares is worth the value of the company. That value of the company is calculated by adding up all future cash flows from that company, but discounting them back to today's money. Basically, we're looking at what the company will earn in the future and then take out the time value of the money. This method of calculating is called the discounted cash flow, or DCF method. This formula is composed of a time value factor and a risk factor. I won't go in too much detail here because it will get too confusing. But the key takeaway here is that if the interest rates, the risk-free rate or the first part of the formula, if that raises, your discount rate will also rise. The higher your discount rate, the faster your money will lose value over time, and this is exponential. If future money is considered to be worth less in today's money, companies will be valued lower. Seeking Alpha did a calculation about the potential effect an interest rate hike could have on value stocks and on the more volatile growth and even high growth stocks. If the interest rates rise from 0.48% they are today to 2.8% as proposed by the Fed, companies are valued up to 43% lower than they are today. If the Fed continues to rise interest rates to 5%, this will have an impact of minus 63% on stocks. That sounds bad, doesn't it? And that is exactly what Jim Cramer is preaching. But he is forgetting one very important part. The market is not logical, and it behaves like a small child throwing a tantrum. The DCF is not the only model that moves the stock market. Markets always keep an eye on the future as well. A lot of bad news and good news is already known, and it is translated in stock market prices. When the interest hikes were announced in December 21, the markets reacted to the news. When the actual hikes will happen, the stock market won't move too much, since it's already calculated in the prices. By the way, don't forget that interest hikes only occur when the economy is strong. So we can assume that the companies will continue their growth. They will continue to grow their businesses, albeit a little bit slower. There is a strong correlation between higher interest rates and higher stock prices, but there is no causation. Here at the Money Network, we're pretty sure that panicking about potential market turnarounds or even crashes when the interest rates rise is completely useless. If you look at all the historic rate hike cycles, we can see that the S&P 500 has grown 14 out of 15 times during times that interest rates went up. So why would it be different this time? So, how to prepare for 2022? Well, that question is pretty easy. There is no reason to panic, and definitely no reason to try to time the market by selling all your growth stocks at the moment and trading them in for value stocks. Don't listen to the loud bad news criers on the news, but do your own due diligence, do your own research, find out your own conclusions, and keep investing the way you were doing before. Again, if interest rates are about to go up, this means the economy is doing great. There is no reason to panic. A recession might happen due to the hike in interest rates, but understand that this recession is also part of the life cycle of the economy. It's not the end of the world. Stay invested in a worldwide allocation of stocks and trust that the world economy will continue to grow. It will, don't worry. So if you're not yet a member of the Money Network, feel free to subscribe to our channel and join us today. And also, if you've enjoyed this video, if it was useful to you, please leave a like for the YouTube algorithm. We thank you very much, and until next time.